What's up, guys? Eric here, Mr. Fired Up Wealth. How you guys doing? Hope you're hanging in there. Just wanted to bring you a quick video here for the weekend. Obviously, things have gotten much worse in terms of the coronavirus, COVID-19, and markets are actually getting beat up again today a little bit. S&P's back to 2337, Nasdaq's below 7,000. The Dow's hanging in there about 19,500. So obviously it's been a rough couple of weeks, not only on a personal level. Health is most important. So first and foremost, I said this in the Fired Up Wealth Facebook group last night, but first and foremost is your health. You can't buy back your health with any amount of money. So keep that in mind. Always remember that your health and your family are most important. So right now, we need to take care of ourselves. We need to take care of our neighbors, our family, do the right thing, follow the guidelines. But with that said, obviously we're still looking at the markets and we're trying to decide what to do because our future can depend heavily on what we do here with our portfolios. So obviously, I'm down. I've been buying. I've bought all the way down. I've done a pretty good job of actually, buying in larger amounts as it goes a leg lower. And I'm still working now and I'm continuing to make good income. And so as the money's coming in, I'm investing that money and it does buy me some time. So each situation is gonna be different depending on if you've got, money on the sidelines or not. You can see the QQQs, they're starting to, hanging in there about $175. Looks like maybe you'll see a little pop at close here. We had, we had a witching today, and basically there was, I think it was $1.5 trillion worth of options contracts that expired today. So it's very, very volatile. The VIX actually has calmed down quite a bit. It was in the 80s, and we've come down into the 60s. I think at one point today we were even in the high 50s. So that obviously is a positive, but, there's going to be more news that's going to come out every day. Eventually the market's forward thinking. So eventually the market is going to take everything in discount and they're going to be ahead of the situation. The market is always forward looking. So are we there yet? Most people will tell you that we probably haven't hit a bottom yet. But at the end of the day, nobody really knows. And this is completely uncharted territory. And the news will make the market go up and down on a daily basis. So technicals are, less important. Fundamentals, we don't really even know. We just don't have any data. And so, the news is really what is going to drive the market higher and lower on a daily basis. So keep that in mind. I recommend, if you are going to buy, to wait, buy on down days, because we're going to have these big swings, 5% up, 5% down. The Qs I actually got earlier this week at $169 for the QQQ. So I'm going to show you a list of the companies that I have on my watch list. Some of them I've been nibbling. As far as the Qs, the price targets, so we're at the 175 now. We're actually below it, 173. 169.25 and then 165. The lowest technical reading that I see is 145 for the triple Qs. I really hope we don't get there. I think the chances of getting there are low, but it is a possibility. So I'm buying the next time it goes back in the 160s. I'm looking for 165 to buy a big lot. 165 or lower is kind of what I'm looking at, and I hope it doesn't go that low. But that's where I'd be buying again. If it never gets that low, that's fine. Then I've got cash and I'll assess, later where I'm going to put that in individual stocks. But I recommend focusing on either individual stocks of companies that have strong balance sheets that are going to perform well and that are going to rebound faster, which I'm going to get to in a second. So stay tight. I'm going to show you a list of about 20 stocks that I think have the potential to do just that. But the Qs, I think, are going to give you a better chance because if you look at what's in the triple Qs, you've got all the FANG stocks. It's the NASDAQ 100. You've got, Amazon. You've got Microsoft. You've got Facebook. You've got Google. You've got Netflix, on and on and on. There's things like Intuitive Surgical. There's a little bit of Tesla in there. There's Lululemon. There's all kinds of these great high growth names. And those are the ones that will probably rebound the fastest, especially in technology. When you think of the stay-at-home and the work-from-home economy, this is going to create opportunity for companies like Amazon, like Zscaler, like Zoom that you've seen, ticker ZM. So let's just take a look real quick at let's just take a look at my playlist, or my playbook, I guess. I'll do my own little NASCAR slide here. This is what we call it in the sales world. So when you have a bunch of clients that you've sold to, you put up we call it a NASCAR slide. These are companies that I think will do well in this environment and recover quickly. Domino's Pizzas, they're hiring 10,000 more employees. They're doing a pretty good job of trying to, delivery. That's what they're good at, right? So their core competency is delivering pizzas. They've done it for a long time. They're exceptionally good at it, and they're seeing an increase in business because, believe it or not, 50% of all meals used to be eaten at restaurants in America. Half of all meals. And now, when everybody's literally staying at home, there are some curbside pickups or some restaurants. My wife and I are part owners of 2 restaurants, and sadly, they're in Minnesota, and sadly, both of those are closed right now. Our employees are probably at risk of not having a job, which is sad to say. And, we're doing everything we can to work with the lenders and work with the mortgage, company and do what we can to try to keep people employed as long as we possibly can. But our business is slaughtered because, we were a dine-in. Both restaurants were dine-in. Domino's is going to do well because they're delivering pizzas and they're doing more and more of it. You got Take-Two Interactive, of course, video games, makers of NBA 2K. They just got a deal with NFL, so they're making an NFL football game. Grand Theft Auto, they also have as well. But that, especially the younger generations, even adults, are playing video games when they're at home, and it's a good way to get some social activity and talk to friends. Speaking of that, so Logitech, you need headsets, not only for gaming but also for work. The camera I'm talking to you on is a Logitech camera, so people that are doing work from home, that are doing conference calls and video conferencing, they're going to need peripherals and Logitech devices. Intuit, already a great company, strong model. People still have to do their taxes, no matter what. And more people are going to want to do it from home and not go to H&R Block, not, go out. They're going to do it on their computers at home. And I think with TurboTax, QuickBooks, and Mint, Intuit is stronger than ever. Verizon, people aren't going to generally cancel their phones. You got a huge 5G super cycle coming up, and I like Verizon. I even like AT&T here. Both of them yield, great. AT&T got hammered today. It's yielding 7.5%. They cut their share buyback. Verizon pays, I think, close to a 5% yield. Waste management, people still need their garbage picked up, and if people are consuming even more at home, I would imagine that their business is doing probably better than ever. Zscaler, that deals with working from home and cloud security. So that's one of the many companies that benefit from that whole cloud and cybersecurity space. There's a bunch of them. So you can look at like CrowdStrike. They reported earnings last night, had a really good quarter. We're up like 15% last time I checked today. Lockheed Martin has been abused, and that's a defense company that isn't going anywhere. They're still going to have contracts with the government. It's trading very inexpensively right now, low PE, good dividend. Snapchat, you're gonna see more and more people, especially younger generations, that use Snapchat, communicating with their friends that way, being advertised to. And I think it's going to be a growth accelerator when we come on the other side of this. More and more people are going to have Snapchat chat accounts. They're going to have more friends on Snapchat. They're going to be more used to using it all the time and more addicted, unfortunately. But that, is a good play. Same with Facebook. Facebook is inexpensive right now. Has a pretty good balance sheet. Probably not going anywhere. They're doing a good job of advertising local businesses so that you come and do pickup for food and things like that, and help the community by donating to kids and things like that. But there are a lot of ad dollars that are still being spent on Facebook, and I think that they'll probably Same reasons that Snapchat have an acceleration effect. Progressive insurance is inexpensive. The thought behind Progressive is that there's going to be less people on the road. There's going to be less accidents. It's a lot of car insurance. So people are still going to have, you're not thinking probably about canceling your car insurance. Maybe you are, but I'm not like, I'm going to go cancel my car insurance because I'm not driving as much. You still have car insurance, less people on the road, less accidents. Honeywell, it's just beat up. It's a great company. It's been in some other videos. Disney, same deal. If you can get Disney at $80 or less, I think it's going to be a generational buying opportunity in that stock. I'm not sure what it's trading at right now. Earlier it was in the high 90s, but I believe it got to that $80 range at the worst point of this week, and I think it'll probably get back to that range. Pepsi, they're buying Monster. Actually, they're buying Rockstar energy drinks. I've liked that company for a long time. It's still a little bit expensive, but as a staple, people are going to be buying, Pepsi. They also have a lot of snacks. So when you think of Pepsi, they've got Doritos and all, go look at their website. They own a lot of stuff, but a lot of those staples are things that people are going to be eating more of when they're at home. DocuSign, of course, you're going to be doing more things remotely, doing more signatures, closing on a home, on a mortgage, on a business deal. DocuSign's business is going to explode. Already was doing well, and the stock has actually run up quite a bit. The same with Zoom. Zoom's not on here because it's just ran up so much. I think it's up like 200%. But I do like Microsoft here because Microsoft Teams. And if you're more interested in some of these tech names like Microsoft, take a look at my last video, the DGIF series for tech. I do a good job of breaking down Microsoft. I think I do a good job of breaking down Microsoft and Apple and the reasons that you'd want to own those. Apple and Microsoft, strong balance sheets. Microsoft is going to benefit from the whole cloud infrastructure, from the work at home environment. Apple, I think, is impacted in the short term with all their stores being closed and everything. But with the 5G super cycle coming up, they're going to benefit, and they've got a strong balance sheet. They're not going anywhere. They've got cash, and so they can weather the storm. And I think that's all of them on that list. So take a look at Costco. Costco, of course, I don't even have to explain why Costco is a good pick. I've owned Costco for, a number of years, and it's been a great stock, and it's blowing the doors off now because people are buying more and more stuff to eat at home. They're hoarding everything they possibly can get, from diapers to toilet paper to, chicken breast to, whatever, Clorox wipes, whatever they're all, buying. So Costco is going to do well, continue to do well. But there you go, guys. That's kind of my little playlist of stocks that you can start maybe picking at if you haven't already. I think the market probably will go a little bit lower. But with that said, you can never time the bottom. So I think the best thing you can do, especially if you've been waiting this long and you've got a lot of cash, I've been buying on the way down and I still have, some cash. But if you're heavy cash, I think, you can start a fifth of a position, a tenth of a position. You can be as risk adverse as you want and just nibble a little bit of these companies. I don't think you're going to do, I don't think you're going to regret buying at these levels with most of these companies. Of course, I could be wrong. Maybe Disney will go bankrupt. I just don't see that happening. So, do what's best for you. But I like these names, both medium term and long term. I think if you buy these in dollar cost average in and hold them for, 5 years, I think you're going to be pretty happy with your portfolio. So thanks for watching. If you haven't subscribed, please click the red subscribe button. If you haven't stopped by the Facebook group, please do, and join us there. We've got about 1,500 people on there. Love to have conversations after hours on the weekends and evenings. And of course, we all have a lot more time being at home more. So love to see you on the Facebook group. Thanks again for watching. Have a great rest of your day. Take care of yourself. Take care of your family. Have a good one.